Hello and welcome back to our weekly Tea Break series here at the FT Studios in London, alongside my co-host Yuri Bender. Joining us today is Yevgeni Agerd, founder and CEO of digital wealth management platform Welrex. Yevgeni, how are you?
Good, thank you.
And what tea have you gone for?
It's Earl Grey.
What's the purpose? Why have you gone for the Earl Grey?
Love the name and love the taste.
Right.
Love tea.
Interesting. I mean, I'm a big lover of tea as well, and I love every kind of tea, to be fair, and I try and drink a different one each week. But, you know, you've got a few old favourites, and I've gone for the green tea. And I suppose at the end of the day, that's the difference between the humans and the robo-advisors, because we have to stop and have a cup of tea or coffee every hour or two. And the robots, they don't need to waste time and put the kettle on and have a chat with their friends. And I think you were looking at these differences in your interview, Ali, with the Chief Investment Officer of St James's Place, Justin Onugwusi. What did he tell you about this humans versus robots debate?
Yeah, I had a quite fascinating, discussion with Justin. He told me about kind of the importance of human investment officers emphasizing, their role in balancing labor and capital and kind of overseeing regulations as well, but also maintaining critical relationships with investors. Yevgeni, in your kind of tech-led business, are the clients still crying out for human relationships, or are they happy to do everything with a digital interface?
Well, the more important the decisions and the higher the stakes, the higher significance is attributed to a relationship of trust and professionalism. However, these days, human relationship is insufficient. You need to augment human capabilities as much as possible with proven and effective technology solutions that cut to the chase and make things much more efficient. So when it comes to significant clients, there's still a huge emphasis on a relationship. And at Welrex, we empower our independent relationship managers with all the necessary tools. The combination between human intelligence and technology efficient frontier is the key in our view.
Justin also talks about the proliferation of AI-related funds. Yuri, your old friend at Fudan University in Shanghai, Professor Charles Shang, has been doing some research about the tech revolution in asset management. What are his findings?
Well, I've been speaking to Charles Chang at Fudan University, where he's the Deputy Dean of the Finance School for a few years now. And Charles and his fellow professor, I think Chloe Yang, her name is, yes, Chloe Yang, they've been researching this area for about 5 years, and they've studied 4,400 companies over that 5-year period, and they suggest that the location information captured from our mobile phones and other devices can predict both key accounting variables and stock prices, and that this big data provides potentially a more reliable way to select stocks than studying traditional fundamentals. What is your view, Yevgeni? Is this a very much a pioneering approach, or have you seen this before?
The alternative data, such as credit card information data to gauge consumer spending, or satellite images of the cars parked next to the shopping malls to, again, understand sales, or let's say container shipping data from China to verify the official party line economic rhetoric, has been long used by the likes of hedge funds and some other investment managers. So we can see a big push for alternative investment data without any doubt. On the flip side, if you say that based on this data, the quant strategy is set to outperform everybody and everything, we will respectfully disagree with that, because if alpha is not generated through genuine fundamental research, that may or may not encompass this alternative data, then the edge in performance is probably unachievable in our view.
But this is probably part of a broader trend to not just alternative data, but alternative assets as well. I mean, people are looking at a much bigger universe of investments, not just the traditional stocks and bonds anymore. And I was speaking to Franklin Templeton earlier this week, and my colleague Elisa was speaking with several family offices and what the private banks call external asset managers about this trend. Is there a definitive appetite now for alternative assets, the non-traditional investments?
What we really see is the rise in popularity of such instruments as, let's say, crypto-linked ETFs. We see a lot of demand for fractionalization of the access to private equity. We've seen many global fund houses launching retail funds which have minimum entry barriers as little as equivalent of $10,000 for retail investors, and they're backed by huge investment houses, which gives additional credibility. So there is proliferation of all those instruments. But when you're talking about private assets definitively outperforming traditional assets, whichever way we define both, we don't see that as an axiom, because it all really depends on the economic cycle. It all really depends on the base rates, it depends on the costs of borrowing, and it depends on the ability to exit. And still we see that the fraction of private companies compared to listed companies is relatively small, even though the popularity of keeping businesses private is rising.
And of course, I guess wealth managers and private banks may use alternative assets to help differentiate and define themselves and their brand. We have a great question for you, Yevgeni, from one of our viewers, from Patricia Roberts from Coutts in London. She asks, how are wealth management companies evolving their branding as they focus on new money in addition to old money?
It's a very interesting question. However, the framing of this question, in my view, is not necessarily applicable, because you don't really differentiate old versus new money. What you really focus on when you are a wealth manager is the client's need, and what generation that need pertains to is a secondary issue, because if you get the basics right, which are about investment performance, relation based on trust, the efficiency of the delivery of what your marketing messaging is through your operations, then you don't have to diversify between old and new money. This is about people. This is about making an accent on the, let's say, engagement model that suits them best, and on the investment strategy that is best suited to their personal and financial situation.
The viewer is from Coutts, and I think maybe they're in this conundrum about how to define themselves, because they've got, I know that they've got a lot of old money, the royal family, and then they've got the new money coming in from the celebrities, from the rappers, from the musicians, and they're probably thinking, how are we perceived? But I think you're right, Yevgeni, because whether it's old or new money, the investment issues are exactly the same, and all eyes currently at the moment, for instance, on the US and Trump's influence on the domestic market, as well as China and Europe. All our commentators, I was recently speaking with the BNP Paribas Chief Investment Officer Edmund Ching, and we also had an opinion piece from the TMF private wealth boss Tim Horton. They're all suggesting it's time to diversify away from the Magnificent Seven and the US markets. But Europe's in a bit of a mess, Yevgeni. What might be a key catalyst for the old continent to bounce back?
Back in November 24, Chief Investment Officer of Welrex recommended diversifying away from the US markets for several reasons. And that was shortly after Trump's election was confirmed. The key reason was that Magnificent Seven are clearly overvalued, and we've all heard that from every toaster out there. The additional reason is that the debt level in the US is absolutely unsustainable, and some of the policies from the new administration are going to only make matters worse if they are enacted the way they are positioned at the moment. And most importantly, the marginality of many US companies has reached its peak, and the overall weight of the US equity markets in proportion to global markets has reached nearly 70%. This is a little bit out of the ordinary. Now, the catalyst for Europe is predominantly peace in Ukraine, and President-elect, or now is already president who assumed the powers, despite, as one of the Economist commentators ironically said, a lot of trumping during his inaugural speech, there were some messages that are clearly leading us to believe that peace in Ukraine is possible, and is possible quite quickly. Trump's ambition to get a Nobel Peace Prize for ending all the wars and not starting any new ones,
apart from in Panama,
is admirable, even though there are some conflicting statements on the other hand. But we're hearing that there is a lot of negotiating activity happening at the moment through official and unofficial channels in Ukraine. President Zelensky is expected to visit Trump in New York in the end of January. Call with Putin is scheduled for near-term personal meeting between Putin can happen in March. So in the first half of the year, there is a very good chance that the peace agreement can be made. And there is definitely a will, even though there is many rivers to cross, there seems to be a way. And if the war is over, then European companies, aided by partial lifting of Russian sanctions and predominantly aided by lifting of the sentiment, are going to outperform. So we see Europe as a big beneficiary, and peace in Ukraine is a major catalyst of that.
Well, let's hope that there is peace in Ukraine the next time we meet here, maybe in the summer, Yevgeni, and that also lifts the fortunes of the moribund European economies. And until then, here's something for you to remember us by. Here's a PWM pen, which we'd like you to use on the odd occasion.
I can sign some documents, like Trump signs a lot of executive orders, but they say executive orders are insufficient to fundamentally change the country. Legislation needs to be passed.
Thank you so much. We hope you enjoyed today's episode and found it insightful. Now, we'd love to hear from you. Do you have questions about investing, AI, or the future of wealth management, or any industry trends? Send them in and we'll put your questions to our guests every week. Please check out the PWM website for more information. See you next week.